Okay, let's unpack this. Have you ever been promised something was going to absolutely change your life, make everything faster, better, more efficient, practically make your coffee in the morning, only to find out it actually makes you slower and makes you want to bang your head against the nearest server rack? Because, dear listener, we might just be living that exact, slightly maddening dream with our shiny new AI overlords. Today, in this deep dive, we're plunging into the delightful chaos that is the current AI landscape. It's a place where the stock market is soaring to dizzying heights, fueled by promises of digital nirvana, but real-world productivity is, well, taking a rather scenic detour through a ditch somewhere. We're going to pull apart a genuinely astonishing study about coders and AI, dissect the head-scratching financial absurdity surrounding the Magnificent Seven tech giants, hear directly from Sam Altman himself, and finally, ponder if we're not just in a bubble, but in a ridiculous self-sabotaging loop where we think we're productive when we're actually just futzing around with a very expensive, very overconfident digital assistant. Welcome to this deep dive, where we strip away the hype and get to the delicious, sometimes slightly unsettling truth from the sources you shared with us. If you appreciate us cutting through the digital fog, take a moment to hit that like button, subscribe, and tell all your friends, especially the ones who just spent their life savings on a revolutionary AI-powered toaster. Let's dive in. So for years, the narrative around AI and programming has been one of impending superintelligence. We've been told it would render coders obsolete, that it's the poster child for AI's capabilities, where the robots would shine brightest. It felt like the perfect application, right? Clear problems, logical solutions, tons of data.
It did. And that's what makes the reality so fascinating and frankly, a bit unsettling. A recent study by the think tank Model Evaluation and Threat Research, or METR, which represents the most rigorous test to date, absolutely blew everyone's expectations out of the water. They aimed to quantify AI's impact on developer speed, and the results were truly counterintuitive.
And when you say blew out of the water, you mean like sunk the battleship, torpedoed the whole damn thing, right? Because the initial predictions from experts were that AI would speed developers by nearly 40%.
Wow.
And the participants themselves, the actual developers, thought they were about 20% faster. They felt the boost.
Exactly. They perceived a speed increase. But when the METR team meticulously looked at the actual work output, the hard data, they found a stark contradiction. Developers were, in reality, 20% slower when using AI than without it.
Slower.
Nate Rush, one of the authors, was quoted as being stunned. He said they didn't even really consider a slowdown as a possibility. The perception was completely out of sync with the empirical results.
Good grief. So AI made them less productive. That's like hiring a personal trainer who just helps you gain weight, or a fancy GPS that constantly tells you to make illegal U-turns. One participant hilariously called it the digital equivalent of shoulder surfing, an overconfident junior developer, that guy, full of bluster, constantly suggesting things, but you end up spending more time fixing their screw-ups.
Right, than if you just done it yourself.
Exactly. What does that analogy tell us about this capability-reliability gap you mentioned?
That analogy perfectly encapsulates the core issue. What the study highlights is precisely this capability-reliability gap. AI systems can indeed perform impressively complex tasks. They can generate code, write emails, sure, but they critically lack the consistency and accuracy needed for reliable real-world application. The output often looks plausible, but it's subtly flawed, sometimes disastrously so. A previous METR study, for instance, showed a mere 50% success rate for AI in coding tasks when left to its own devices. 50%, which essentially makes the AI useless on its own, as they put it.
Useless on its own? Wow.
Yeah. So developers in this newer study spent a disproportionate amount of time checking, debugging, and correcting the AI-generated code. They found it was often quicker and honestly less mentally taxing to just write the code from scratch. The cognitive load, the mental effort of constant vigilance and correction actually slowed them down.
So, if even in coding, which, let's be honest, many argued was one of AI's absolute best use cases, with its structured logic, abundant training data, clear definitions of success, if it can't reliably speed things up there, what on earth does that mean for your work, dear listener? Where tasks are often far less clearly defined, success is a moving target, and there's no easy undo button for a bad suggestion, it certainly makes you think twice about the productivity boosts promised by your new AI assistant. Now here's where things get truly paradoxical. While actual productivity seems to be doing the limbo under a bar set surprisingly low, the stock market is having an absolute champagne party, an absolute rager. We're consistently told we're in an extraordinary AI-fueled economic boom. Billions, even trillions, are being poured into infrastructure and development. It feels less about hard data and more about a fervent belief system, a kind of collective euphoria.
And that, if we connect it to the bigger picture, is the crux of this massive paradox. While the valuations of AI-associated tech giants are soaring to, frankly, unbelievable levels, evidence is piling up that AI is still largely failing to deliver tangible, measurable results in the real world. Research from various sectors suggests that companies trying to incorporate AI have seen virtually no discernible impact on their corporate bottom lines. The enthusiasm is purely speculative, it seems, rather than grounded in proven economic gains.
The Magnificent Seven, you know them: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. These companies account for over half of the S&P 500's growth since 2023. They're seen as the AI revolution's darlings, the chosen ones, right? Destined for infinite glory and market cap.
And yet, their prosperity has largely yet to materialize anywhere beyond their share prices, with one key exception: Nvidia. Nvidia provides the crucial chips everyone else is buying, so they're making bank. But what's fascinating and maybe concerning is that Alphabet, Amazon, Meta, and Microsoft, for instance, have actually seen their free cash flow decline by 30% over the past 2 years.
Hold on. For some listeners, free cash flow might sound like jargon. Can you quickly clarify what that means for a company? Why is that significant?
Absolutely. Good point. Free cash flow is essentially the cash a company generates after accounting for cash outflows to support its operations and maintain its capital assets, buildings, equipment, what's left over. The money a company truly has available to pay down debt, pay dividends, buy back stock, or invest in new ventures without needing to raise more capital. So a decline in free cash flow, especially when revenue is supposedly booming or expected to boom, signals that the underlying business isn't generating the kind of profit one might expect from such high valuations. Or it means they're spending an enormous amount, maybe desperately, to try to achieve that growth.
Got it. And here's a real kicker, just to sprinkle some salt in the wound. By the end of this year, Meta, Amazon, Microsoft, Google, and Tesla will have collectively spent an eye-watering $560 billion on AI-related capital expenditures since early 2024.
$500 billion.
$500 billion. Yet they've brought in a relatively paltry $35 billion in AI-related revenue. Capital expenditures, just to be clear, are those significant investments in physical assets or infrastructure, like those massive data centers we keep hearing about. So that's $500 billion spent for, not much return so far. And OpenAI and Anthropic, despite fast growth and mind-boggling valuations, OpenAI at $300 billion, Anthropic $183 billion, they're still nowhere near profitable. Talk about betting on a fantasy.
It really is like building a gold-plated rocket to the moon without any fuel and then wondering why it hasn't left the launch pad. And this isn't just us talking. Gartner, a highly respected tech consulting firm, has even formally declared that AI has entered the trough of disillusionment phase of technological development.
The trough of disillusionment sounds cozy.
Right, for those unfamiliar, this is that predictable period where the initial massive hype gives way to widespread disappointment as a technology struggles to deliver on its grand, often overblown promises. This raises a really important question for investors and businesses alike. Is investor excitement simply way too far ahead of the technology's near-term benefits?
This all sounds awfully familiar, doesn't it? Like if you squint, you can almost see the ghosts of dot-com companies in cargo shorts slitting through the server racks, muttering about synergy and Web 1.0. We've seen this movie before, haven't we?
Oh, absolutely. History, in its flawless, if painful, track record, consistently shows that parabolic rallies and next big thing, innovations always get upended. The internet boom, genome decoding, 3D printing, blockchain, cannabis, the metaverse, they all experienced an early-stage bubble burst. Investors consistently, and quite optimistically, overestimate how quickly new tech will actually be adopted and, crucially, monetized across industries. This pattern often leads to market leaders losing a staggering 80% to 99% of their value when the correction inevitably hits. It's strikingly consistent, painfully so.
So if I'm hearing you right, we're saying AI is undeniably a game changer, eventually a foundational technology, sure. But right now, it's just a really expensive mirage, shimmering tantalizingly on the horizon while we all wander around lost in the desert, convinced we're about to find an oasis. What's a good indicator that we're truly in bubble territory, beyond just the gut feeling?
Precisely. A solid indicator we're firmly situated within a bubble is the simple fact that most businesses, outside of the direct chip manufacturers like Nvidia, can't lay out a clear, actionable plan for a positive, quantifiable return on their substantial AI investment. They're spending huge sums because of FOMO, fear of missing out, or perceived necessity, maybe pressure from the board, not because they've robustly calculated an ROI. That's classic bubble behavior.
Okay, so beyond the general over-optimism and FOMO, what are some of the more concrete factors that could actually pop this thing, send us all scrambling for the exits? Because a mirage can't last forever, right?
Well, one significant factor we're already observing is the expected resolution of GPU scarcity. Nvidia's Hopper chips, for example, were previously in such high demand they were backlogged for months and commanded huge premiums. It was like gold dust. However, competitors like AMD are now rapidly ramping up their production of comparable chips. And maybe even more importantly, Nvidia's top customers, companies like Google, Amazon, Microsoft, they're actively developing their own custom AI GPUs in-house.
Cutting out the middleman.
Exactly. This influx of supply, combined with increasing self-sufficiency from major buyers, will inevitably reduce Nvidia's pricing power and margins, which have been, let's face it, artificially inflated by the insane demand of the last few years. The scarcity premium is easing.
Plus, let's not forget the geopolitical chess game. The U.S. government is still playing hardball with China, actively restricting high-powered AI chip exports. And if former President Trump's proposed 35% tariff on Chinese imports were to actually happen, that would seriously escalate a trade war, potentially straining AI product sales to one of the largest markets in the world. That could definitely deflate the balloon of global AI enthusiasm and profitability.
It's a significant external risk factor for sure. Adds another layer of uncertainty.
Okay, let's talk about those eyesore valuations, shall we? Because frankly, some of these numbers make my eyeballs want to retreat into my skull. It seems we're collectively buying future promises at today's astronomical prices.
It's pretty wild. Historically, market leaders in these next big thing innovations tend to peak valuation-wise at around 30 to 40 times their trailing 12-month sales. Think of Amazon and Cisco right before the dot-com bubble burst. These were companies with incredible growth, but their valuations eventually became unsustainable.
Right, and just quickly, trailing 12-month sales, that just means the total revenue the company made in the past year, right?
Exactly, just the revenue over the last 12 months. So today we see Nvidia, a phenomenal company, no doubt, having topped a price-to-sales ratio of over 40. And Palantir Technologies is pushing almost 69 times sales.
69.
Yeah, these current numbers are significantly higher than historical peaks for comparable high-growth tech companies, indicating a substantial amount of future growth and profitability is already priced in. It's an enormous amount of expectation baked into the present share price. That's a lot of hope pinned on future performance, not a lot of immediate profit to back it up. It's like paying an incredibly steep price for a lottery ticket, really. Hoping for a payoff that's far from guaranteed. And speaking of profits, or rather the lack thereof, even the CEO of OpenAI, Sam Altman himself, has admitted to believing we're in a bubble. He's not exactly a small player in this field.
Indeed. In a rather candid recent interview, Altman stated, and I quote, "My opinion is yes," when explicitly asked if investors are overexcited about AI. He drew a direct comparison to the dot-com bubble, noting that smart people get overexcited about a kernel of truth. He acknowledged that while the underlying technology is transformative, the market eventually corrects itself when expectations outpace reality, which is, a fairly sober assessment. He also called it insane that AI startups with 3 people and an idea are receiving such high valuations, saying someone's going to get burned there, I think. Which, is pretty blunt coming from someone at the epicenter. But then he pivots, right? Expecting OpenAI itself to spend trillions of dollars on data center construction in the not very distant future, and believes they'll survive the eventual correction.
Right. It's a fascinating mix of candid realism about the market froth and a very strong belief in their own ultimate success, as if the bubble might pop for everyone else, but they'll somehow just float above it all. Good for him, I guess.
But what if it's not just a straightforward boom and bust, a simple inflation and deflation of expectations? What if it's something weirder, a more insidious, kind of soul-crushing economic nightmare that leaves us all feeling vaguely productive but actually just running in place?
This raises an incredibly important question, a truly unsettling possibility. What if the overwhelming hype surrounding AI pushes businesses to expand its use, even if it doesn't actually translate into a measurable increase in productivity? Daron Acemoglu, an MIT economist, he described this scenario where mid to high-level managers are being told by their bosses, you need to use AI for X% of your job to satisfy the board. It becomes a top-down mandate based on perceived value, or just pressure rather than actual results.
So companies, feeling the pressure, lay off workers or slow hiring, genuinely convinced that AI has made them more productive, even when the data doesn't bear that out. You've got to be kidding me. That's like a corporate version of a self-fulfilling prophecy, but in reverse. We think we're more productive, so we downsize, and then we might find out we're actually less efficient, but by then, the damage is done. People are out of jobs.
Exactly. The perverse result could be an increase in unemployment, not offset by actual widespread gains in productivity across the economy. It sounds almost too absurd to be true, but Cal Newport, a computer scientist, he points to a very similar scenario with the adoption of email back in the day.
Email? Really?
Yeah. When email and personal computers emerged in the 1980s, companies quickly saw the potential and laid off secretaries and typists. Seemed efficient, right? But the unintended consequence was that higher-skilled employees ended up spending so much of their own valuable time on communications, scheduling, administrative tasks, stuff the support staff used to handle, that they became less productive at their core jobs.
Oh, wow.
This often forced companies to hire more high-skilled employees just to do the same amount of actual high-value work as before.
Yeah.
Email made us feel more productive because we were handling our own correspondence, but it often did the exact opposite for overall organizational efficiency.
Goodness. So, we might just be heading down the exact same path with AI, convincing ourselves we're speeding ahead while actually getting bogged down by our digital shoulder surfers, only to realize years from now, we've just created more administrative overhead for ourselves, maybe fewer jobs for others, and not much real progress. What a perfectly modern nightmare. So if this AI bubble bursts in a spectacular fashion, it could indeed be worse than the dot-com crash, maybe leading to a recession or even a financial crisis. That's one possibility. Or perhaps the silver lining is that fears of AI-driven job displacement are completely overblown simply because AI just isn't that good yet. But the truly unsettling thought, the one that might keep you up tonight, is this. What if AI's greatest trick isn't replacing us, but simply making us believe we're more efficient, while actually slowing us down, burning through mountains of cash, and ultimately leaving us no more productive, just bewildered, exhausted, and probably needing a very strong cup of coffee? Something to mull over next time your AI assistant confidently tells you it's optimizing your workflow. Don't let your brain enter the trough of disillusionment alone. Keep those synapses firing by engaging with us. What are your thoughts after this deep dive? Are you feeling more productive with AI, or do you sometimes just want to throw your computer out the window? Let us know in the comments below. We genuinely love hearing your perspectives. And if you found these insights valuable, remember to subscribe to this deep dive for more explorations into the fascinating, sometimes frustrating, world of technology.